well, I did a lot of buying in that sort of 2004, 2008 bracket, so a lot of people who have 20-year mortgage products, and probably like me, all of a sudden someone says the mortgage come at the end of the term, and I'm like, surely you can't, that those mortgages for 20 years, and the period's passed. Yeah, I'm guilty of it myself. Surely not. This was tied in for decades, and apparently decades have elapsed.
Absolutely. It is a question that we hear quite regularly as well. I think it's fueled by the fact that as far as the client's lender is concerned, yes, that contract is coming to an end. There wouldn't be an extension. They don't offer that type of situation except in extreme circumstances, and particularly where there might be a vulnerability of the client. But ultimately, that contract with that lender will come to an end. Now, when we assess client circumstances, what we'll be doing is just looking to do a remortgage, but obviously extend the term. But importantly, the terms available aren't similar to sort of the way a residential mortgage would work. So whereas if you were buying a house to live in, lenders would be sort of dubious lending past sort of retirement ages, etc., that doesn't translate over to buy-to-let mortgages. So we have lenders that simply will do a 35-year term for a client that's in the 70s on a buy-to-let on interest only, with sale of property as the repayment vehicle, so that they're not concerned about that type of thing. But it is likely you would have to apply afresh to a different lender. And in some cases, the existing lender is an option, because what the criteria was 20 years ago in terms of maximum ages, etc., isn't necessarily the criteria now, because the buy-to-let mortgage market's moved so considerably that lenders appreciate it really doesn't matter how old a client is, because if a property's rented and the rentability is there, then what difference does the term make? And so they've switched their sort of mindset away from ending a mortgage at 70 or 75, and now regularly would allow mortgages into much later life as well. But I think the key is to contact an advisor well before the term ends, because what you don't want to do is get into a situation where you leave it as late as possible, and then you're behind the curve with your existing lender, who are wanting to sort of foreclose on the contracts, and that means them getting paid back in most cases. But there are lots and lots of mortgage options available to sort of take a term that's coming to an end and actually remortgage to another lender and extend that term, quite considerably.
How much before end of term would you suggest someone makes contact for you to start and sort of work on this?
Again, between 9 and 6 months before the end of the term. I think that then gives the client plenty of time to sort of get everything in order without the panic and worry of a lender sort of, making phone calls and sending letters out asking, how and when the funds are going to be repaid. And also what it does is if there isn't an opportunity for whatever reason, and it would be client related, if there isn't that opportunity to remortgage, then the client needs enough time to be able to make that sale and sell the property, if that's the route that they have to go down. So you need to give yourself enough time to assess the mortgage market, make sure there's a product for you, and then if not, obviously speak to an agent about trying to sort of market the property for sale in good time.
Okay, that's interesting. I know this came up on a conversation today with another client, actually, where similar to something I've done. So as an investor for 20 years, I've had a buy-to-let interest-only product, and that sort of served me well in that interest rate regime where, there was margin there, and that was nice for that period of time that it lasted. Not being funny, you get a little bit older, so I'm now thinking, oh, hang on, I don't want to work forever. I've got these investment properties, but whilst on interest-only, they're of limited benefit to me, if that makes sense. So certainly some of the switches that I've arranged with yourself have included that move to repayment, because I'm now thinking of longer strategy and thinking, well, 50 to 20 year mortgage term to get this paid off puts me at an age where I definitely don't want to work as crazily as I do now. And that those might slow down. So I know I've tied that in with that strategy, and I think I discussed it with another client today, actually, who might think about is it time to think about remortgage finance, but also wider strategy, if you know what I mean, and what are the properties doing for him?
I think that's important, because one of the things I always ask clients when they come to us with a portfolio of properties is what it's there for. What is the purpose of this portfolio? Is it to bring an income to the here and now, or is it to provide for the future in some way? And what does that provision look like, and what sort of timescale is expected on that? Because without that sort of direction and that focus, then you're not really doing yourself the best service by sort of remortgaging without having a proper structure behind you as to what the plan of action is and why you've got that property portfolio. So I think it's important to have those discussions with yourself, really, and decide what the bigger picture is and the longer game, I suppose.
Yeah. I think there are a lot of probably, if the gentleman I spoke with here was a sort of a similar age to me and probably had a similar journey where, they're great for 20 years, and it was nice for the years when interests were kind to us. But now I guess you start to reassess, you get to a different point in your life and you think, well, I don't want these on interest only forever.
No.
Because the benefits to me is limited. And by switching to repayment, they do become a genuine pension pot, because I will, in effect, work for the next 15 years whilst they pay themselves off.
Yeah, and I think
at that point, they do add value.
Yeah, I think people have to get their head round that it is an investment, and you generally pay into an investment in some way, shape or form, don't you? So by having a repayment mortgage, you are investing in growing equity, and having that switch and thinking about changing to capital repayment, or even making some overpayments onto an interest-only mortgage and reducing the capital that way can be a really effective way of sort of growing the equity in the property, ready for when you finally reach the point where you want to do something with it, be that sell or whatever.
Yeah, no, that's interesting. And I have some mortgages where there's voluntary overpayments. And the one thing that we haven't said, it's useful with the voluntary overpayment because you can drop back, can't you? So let's say there was a problem with rent flow on that property. Yeah. In effect, you can drop back to the committed payment only and sort of take the voluntary overpayment away. So.
Absolutely. Yeah, you're typically in control of that, really, Andrew, because the interest-only payment will be on a direct debit, and generally when you make an overpayment, you set it up as a standing order. So if you needed to adjust it or end it, you would just go into your online banking and stop your standing order. It doesn't affect your basic interest-only payment to the bank, which comes out on a direct debit. So it's very controllable.
Yeah. I know the property of mine that I was thinking of, so in effect, it wasn't viable to switch to full repayment because actually it exceeded rent level, so that wasn't viable. But I've committed to putting in effect my almost full rent after costs into that mortgage to try and pay it off in a period of time. But then when I did an illustration as the interest it saved, it was vast.
Yes.
Just committing to that voluntary overpayment, the interest over the life of the term that it was going to save was huge. It was thousands of pounds. So. You probably feel like you're not necessarily chipping away much, but the effect on the interest is quite significant.
Absolutely. Yeah, absolutely. Yeah.
I certainly thought I'd rather save that interest than pay to the lender.
Well, yeah, I mean, they make enough offers, don't they? So any saving is best, isn't it?
Isn't it good? Yeah. So, no, that's really interesting, that one. This is more of an investor question, I guess, for new investors. So